Welcome to Investor's Guide. You're watching ET Now. I'm so glad you tuned in this week. I have a big announcement to make. Next week, we turn 5 years old, which means that we've been sitting exactly here for the last 5 years, helping you with your finances and your investments. Now, I'd like to thank you for staying with us for the last 5 years, but I want to meet you as well. So what we're going to do is we're going to give you an opportunity to record a quick video on your cell phone and email it to us at the email ID that's at the bottom of your screen. Especially if you've benefited in any way from the advice you heard on the show, we'd love to hear from you. Of course, you can put your video on our Facebook page as well, or you can tweet it. You know how to get in touch with me on Twitter. It'll be so nice to hear from you. And of course, we'll be airing these videos that we get from you over the next few weeks. That aside, let's get back to business. On the show this week, we'll help a young man plan for his child. This is the theme of the show today, planning for your children. In our product review, we look at the ICICI Prudential Focus Bluechip Fund, should we stay invested? And we'll answer questions about your insurance investments. All right, let me bring in Dhirendra Kumar, the CEO of Value Research. Dhirendra, thank you so much for joining us. Let's get straight to our portfolio question. Sudhir has written in, he's 36 years old. He works as a software engineer in Noida. Now, he has a take-home salary of 70,000 rupees a month. He invests about 36,000 rupees a year in the LIC Jeevan Saral policy. He has a term cover, he tells us, of 10 lakh rupees. Unfortunately, Sudhir, that's not enough. And he's putting 12,000 rupees in the Public Provident Fund over and above the PF deduction from his salary. 10,000 rupees a month going into HDFC Top 200 is his only mutual fund investment. He has two very young daughters, Dhirendra. They're both under the age of 5, and he wants to put aside money for their education and their weddings, and he wants to save for his own retirement as well. I'm going to start at the top. Not enough insurance, not enough health insurance. From there onwards, where would you like him to take it, Dhirendra?
Yeah, I think so. He just needs to comprehend that long-term investment should be into equity. And except for the mandatory, contribution or PF, Employee Provident Fund contribution, which is going from his employer side and his salary deduction, that's the only thing which is not negotiable. Except for that, he should avoid all that. Even the Jeevan Saral is not, will not be providing him the finest in terms of cover or investment performance. So that is avoidable. And he should methodically plan his exit or discontinuance.
This is the advice you're getting right now. You have to re-look at your term cover. It's not enough. It has to be 10 times your annual income. You haven't mentioned health insurance at all. I'm going to assume your employer gives you some health insurance. On top of that, you need some health insurance of your own. So make sure your entire family has health insurance. And of course, like Dhirendra said, you don't need PF and PPF. Discontinue your contribution to one of them. And the LIC policy, you don't need that one as well. So Dhirendra, he has HDFC Top 200. Apart from that, could you give him a portfolio, maybe among the ones we've designed on the show, that he can use for his goals?
Both goals are many years away. He's still young, so and over 15 years away. So from that standpoint, he should consider one of our two portfolio, aggressive growth or the growth portfolio, and he should be very methodical about it. He can well drop or ignore or not invest in the the fixed income fund, which is part of these two portfolios, because he has I would assume that his employee provident fund contribution, with which he is regular with, and he already will have his accumulation. That should take care of that fixed income allocation, and look at his portfolio holistically, review it annually, and be regular about it, not try and make lump sum investments. So following the basic principles, choose one of the two portfolios.
Well, the other question he has for us, Dhirendra, is his question about property. Now, he bought an under construction property in 2010. He's paid 50% of that amount already without taking a loan. He booked a second property earlier this year and he's made a down payment of 10%. He wants to know, is it important right now to take a loan on one of these properties? And how should he make those payments? Because he's confident that he can continue to pay those installments out of the bonuses he receives. It's important to also consider the tax benefit that we can make from a home loan. But what would you recommend he does, Dhirendra?
When you think of a home, or you accumulate your savings, or you buy a property and your holding period is 10 years, 12 years, 15 years. A few constraints which one should be keeping in mind. One is that if you look at your equity returns as well over such long period, they are fantastic. Compared on the parameter of liquidity, the ticket size, because you can't really look at these modest homes in and around Delhi, will be 25 lakh rupees and more. with all the risk assumed by the investor. Of course, the investors have been, buyers of these properties have been lucky so far that they are not faced with the situation of a project being stuck. But you can't be lucky. Everybody is unlikely to be lucky with, so many projects going on and inherent business risk, where all the risk is assumed by the buyer. So you are assuming risk. The ticket size is big, and it will not be liquid. And compared to that, I think it is justified to do all that when you are accumulating or you are buying a property for your own consumption. But thinking of it as an investment will be wrong, simply because the dynamics have changed. Just that you will have the available borrowing, or you can take a loan, looks tempting, but I don't think it is a wise thing to be doing that today. So choose one of the house which you want to which you plan to live in, and think in terms of getting rid of it and you will save yourself from assuming that big loan and incurring interest on that. Besides that, once you are methodical with your investment, I'm sure that the returns on that investment. One, it will not be a leveraged investment. Think of one downside, that just what happens to these houses which you are buying on a big loan or a substantial loan, and you don't have enough accumulation of your savings just in case you lose your job for a while. That's not a good thought, but it is something which one should be prepared with. Not be leveraged, be conservative with your investment, be methodical with your investments, and have approach which will generate substantial return as well.
Well, 25-year-old Rizwan has written in. He's a young man. He tells us he began investing in the SBI Magnum Tax Gain Fund about a year ago purely to save tax, but he picked the dividend reinvest option. Now he wants to know, has he made a mistake by picking this option, or will he be allowed to switch out of this option into the growth option before his 3-year lock-in gets over? Dhirendra, what would you recommend he does?
Yes, he has done a mistake, because every time this fund pays a dividend, that will be reinvested in the fund, and that amount will carry a lock-in period. So effectively, and subsequently, even on those units which is being getting invested by way of dividend, will also give dividend, and that will get reinvested. So it will become a perpetual lock-in units in this fund. So, and it is not. So it is a problem. He should prevent himself from doing this. There is a way around this. It is not possible for any investor to move his money from dividend plan to growth plan, because it is a financial transaction. Both plans have different NAVs. He will have to redeem his units in an ordinary open-end fund. If you have to switch your plan, you cannot do that. You have to. It amounts to redeeming your units in the dividend plan and making a fresh investment in the growth plan. But there is a way he can actually he can navigate, which is it is possible to change his plan from dividend reinvestment to dividend plan. This is a non-financial transaction. He can fill up a form, say that the dividend to be paid by this fund should not be reinvested, and he will get a check by way of dividend. So that way the money will not get reinvested and will not carry the lock-in. And that money either he can consume, or he can choose to invest in any other fund he wants to.
All right, so there you have it. If you have more questions about your fund, you can write to us. Email ID is on your screen right now. Let's take another question from another young man. Satish Kumar has written in, Dhirendra. He writes in from Bangalore. He's been putting 2,000 rupees a month in the IDFC Premier Equity Plan. He wants to add another 2,000 rupees to his SIP. He wants to know, should he continue investing in this same fund? Does it make sense to add one more fund to his portfolio? He's only 27 years old, so we're going to assume he has a long-term horizon. Would you like him to diversify a little bit from the one fund that he has?
It's an outstanding fund, and if he's just wanting to be keeping it simple, he can well afford to invest more. But diversification is good. Also, from the standpoint of in future he'll be saving more, and he should diversify more methodically. So he can consider a large and a multi-cap fund to add to this fund.
Dhirendra, would you recommend a few multi-cap funds that he can choose from?
If I have to recommend one or two more funds to supplement this fund which he already investing in, I would say Quantum Long-Term Equity Fund, or ICICI Prudential Dynamic Equity Fund, or Templeton India Equity Income Fund.
All right, so all your screen right now are multi-cap funds that Dhirendra recommends, especially for those of you who are investing for the next 10 or 20 years at least. These funds make most sense for you. If you have any questions about your own mutual fund holding, write to us. Email ID is on your screen. Remember, we're also looking for success stories who benefited from this show over the last 5 years. Feel free to get in touch with us. Quick break. On the other side, we'll review the ICICI Prudential Focus Bluechip Fund. We'll find out how it's done over the last 2 months and if you should stay invested. Don't go anywhere. Welcome back. You're watching Investors Guide on ET Now. Thank you so much for staying with us. Dhirendra Kumar is with us as well in our Delhi studio. It's time for our product review. And because so many of you have written in asking about this particular fund, today we're looking at the ICICI Prudential Focus Bluechip Fund. Avan is going to give you a quick introduction. Avan.
Thanks, Faye. Well, the fund in focus this week is the ICICI Prudential Focused Bluechip Equity Fund. The fund, which was launched in 2008, has enjoyed a stellar track record. It focuses a small part of the market, picking on 20, 50, 40 of the largest stocks in the NSE. The fund manager picks stocks based on pre-decided sector weight, placing close to 90% of its corpus in large caps. Despite being launched during the downturn of 2008, the fund managed to beat its category on a year-on-year basis every year except 2012. The fund has consistently been in the top quartile and among the top 5 ranked funds except in 2012. Let's do some math to give you a better perspective. If you invested 1,000 rupees in this fund when it launched, you would have 2,432 rupees today. So should you remain invested in the fund like this? Our experts are here to give you the answer. With that, it's back to you, Faye.
All right, Avan, thank you for that update. Dhirendra, I want to bring your notice to a tweet we received from Praveen Kumar, who wrote in saying, you asked a viewer to sell ICICI Prudential Focus Bluechip. It's still the best in its category. What is your justification for that call? Now, if I remember correctly, when you gave that advice, you were talking to someone who had a 20-year horizon. Given the fact that this fund is still the top of its category, it's a stellar performer, tell us why it suits those people who have a shorter horizon, and for people who are looking at the next 20 years, this is not the best option for them.
No, undoubtedly, this fund remains a great large cap fund. It made a name for itself in the first 3 years. It was among the best performing fund in a very hostile environment for equities generally. And even the large caps were struggling, and in the very year it was launched, it was the best performing fund. Second year too, it was among the best performing. First 3 years were blockbuster for this fund. And this fund, my answer to the other question was in a certain context. If you want a low maintenance portfolio, if you want to diversify enough, then this may not be the finest option. It remains a great large cap fund. And I'm hopeful that over a period of time, the strategy that it follows, even the name reflects that. Focused Bluechip, Bluechips, and a fairly concentrated portfolio. The portfolio doesn't go haywire. Till a certain size, the fund had a mandate not to exceed its the number of stocks in its portfolio beyond 20. Now it can as it has turned big, it can have even more few more stocks, but it's still a handful. And I would say that with its selectivity, it has impressed. It remains an impressive fund. For somebody who is wanting to invest and have a low maintenance portfolio, a portfolio which is not constrained by its design, that should be a fund which can go anywhere, a fund which has proven credentials. On that count, this fund lacks that. This fund will, by its design, by its mandate, will always remain a large cap fund.
All right, Dhirendra, finally, to give us your rating of the ICICI Prudential Focus Bluechip Fund, where would you place it?
No, I would just like to repeat that it remains a 5-star fund among the large caps.
5 stars for the iPru Focus Bluechip Fund. And remember, Dhirendra said it's best suited for someone who wants to beat the index. But if you have a very, very long-term horizon, then you don't want to be limited by just focusing on large cap funds. Let's move on now to our hold or sell segment. Well, 45-year-old Arun Chopra writes in, Dhirendra, he has a very interesting goal. He would like to create a corpus of 1 crore rupees in the next 5 years. Now, he's already putting 1 lakh rupees a month in these mutual funds, and he has 10 mutual funds that he's picked. He wants to know if this is the list that will take him to that magic number of 1 crore rupees. Now, if I look at his entire list, there seem to be a lot of multi-cap funds, a couple of mid-cap funds and a couple of balanced funds. Dhirendra. He also has an international fund. So he's obviously someone who follows your advice quite closely. I'm a little worried about the time horizon of 5 years. It seems a little short for the amount of equity exposure he has. Would you like him to sort of streamline this a little bit, focus a little more on the balanced funds?
Yes, absolutely. One is that he should not get worked up on 1 crore because he is not thinking he is not expecting aggressive return from his investment. His contribution, his principal accumulation is going to be 60 lakh rupees. So one is that he is not expecting extraordinary return from his investment. More so, given the changed outlook for equity or generally from the markets, I would say that it will be all the return can be or his goal can be achieved far more conservatively in a reasonably tax efficient manner just through the balanced funds.
So if we look at his investments right now, Dhirendra, he has 2 balanced funds. He has HDFC Prudence and ICICI Prudential Balanced Advantage. Would you like him to consolidate all of his money into just these 2 funds? Wouldn't that be a sort of compromise on diversification?
It may not be a compromise on diversification if he adds, maybe 1 or 2 more balanced fund and drop all that. In fact, it will be simpler because, when I look at other equity fund which he owns, and the 2 balanced fund, I think that the equity portfolio will be very complementary. They will have a significant common part in the portfolio, maybe managed by the same fund manager too. That apart, he is not losing on any of the advantages of an equity fund in terms of tax efficiency. And also, because the time is short, just in case he is faced with a situation that market is down 15% in next 3 months. How will he withstand that? I think he will be able to navigate it through a balanced fund far too efficiently, in a very calibrated manner compared to all these equity funds, and more so the mid and small cap funds. That could be quite unnerving.
Right. So what I'm going to do is on the screen, I'm going to put up our stable growth portfolio. Arun, these are 4 balanced funds, and this portfolio was designed for someone with exactly your goals and your time horizon. It might suit you best. And of course, you can get back in touch with us if you have any more questions. Well, Kruti has written in. She invests in the SBI Pharma Fund and the HDFC Mid Cap Fund. She wants to know if she should continue to invest in both of these funds or choose a fund from another sector. She can make a monthly investment of 50,000 rupees, and she wants to know which fund she should invest in right now. Would you like her to continue investing in that pharma fund, Dhirendra? You normally tell us to stay away from all of these sector-specific funds.
Yes, it's always avoidable to have any sector fund or any thematic fund because these are they do very well at a particular time. And right now, it is not unusual to come across investors who have this pharma fund or FMCG fund as a significant part of their portfolio, or old investors, 5-year-old investors who are loaded with, the power fund or energy fund or infrastructure fund. So investors chase performance, and as a result of it, and these sector funds generally they are either at the top or at the bottom. And so be prepared for, these funds settling down at, not delivering as good a return as they have done in the recent past because times are changing. And the reason why you should actually have a diversified portfolio or a portfolio which is not a sector fund is the objective. Be with a good fund manager. Choose a fund which can invest all over because anything which cannot invest all over does well sometime, not all the time.
So what would you like her to invest in, Dhirendra? Could you give her the name of one fund that she can use right now for her goals?
A meaningful addition to HDFC Mid-Cap Opportunity, which is an excellent fund, could be a multi-cap fund. If I have to recommend few, I would say Quantum Long-Term Equity Fund for its lowest cost and great performance. ICICI Prudential Dynamic Equity Fund, or Templeton India Equity Income Fund.
All right, so those 3 funds are on your screen right now, specially suited for those of us with a long-term horizon. Dhirendra, thank you so much for joining us on the show and answering all of our questions on Investor's Guide. Remember, if you have any question at all to do with your money, whether it's mutual funds, insurance, loans or tax, write to us. Email ID is on your screen right now. We'll come back from the break and we'll talk a little more about investing in insurance policies. Don't go anywhere. Welcome back. You're watching Investor's Guide on ET Now. We've brought in Gajendra Kotari this week to answer more of the questions you sent in on your insurance policies. Gajendra, thank you so much for joining us. Well, Hari Babu has written in. He tells us he invested in the HDFC Young Star plan in 2008. Now, this is a child plan. He tells us in the beginning, the investment gave him good returns for 3 years, but now the NAV is very low, and as a result, his total investment is lower than the capital he put in to begin with. He wants to know, should he continue investing in this ULIP or should he pull his money out and invest somewhere else? Gajendra, we have to remember that this is about the future of a child, so we have to be very careful about the advice we give him right now. He's invested halfway through. This is a long-term policy. What would you recommend he does?
Actually, the plan which you've chosen is an insurance plan, and this is normally a little expensive compared to other investment options. But because this is for a long haul, I will recommend you that you can choose the funds which can deliver good and stable returns over the longer term. So if you don't mind taking little higher risk, then you may go ahead investing in a balanced fund or into a growth fund which invest most of the money in equities. And considering next 5 years we have a stable government, equities should outperform bonds. So I think this will be a greater option for you. And secondly, the policy admin charges are also very high. So you have 4% policy administration charges up to a max of 6,000 rupees. So even that is eating away into your returns. But having said that, we have no choice. But I think the only thing we can do is change our fund to a better performing fund and expect a better returns over the next 5 years or so.
Well, Sanjay has written in. He writes in from Bangalore. He tells us he watches the show on a regular basis and he finds it useful. Sanjay, it's always a pleasure to hear from viewers like you. Now, Sanjay's been investing in the ICICI Prudential Guaranteed Savings Insurance Plan. He puts in 2,000 rupees every month, and he's been doing so for the last 3 years. Now, he does know that the policy will only mature after 4 years. But he wants to know if he should continue this investment. He's not very impressed with the way the plan is doing. Gajendra, what would you recommend he does?
The ICICI Pru Guaranteed Savings Insurance plans which you have taken is actually pure endowment plan, and unfortunately this is one of the worst kind of plans in insurance because you're neither properly invested or nor adequately insured. Since you've already completed 3 years, you can consider exiting out of this plan, and you can actually look for a term plan of 50 lakhs or so. Though the surrender charges are very high, but I think it's a better option to cut your losses right away rather than nursing it for another 3-4 years.
All right, we have time for one last question. Gajan has written in. He tells us that an LIC agent got in touch with him in 2008 and suggested he buy the Jeevan Saral policy. He also told him it will give him same returns as the PPF. He lied, first of all. Now he tells us that LIC has declared a loyalty bonus of 250 rupees on his policy, and he suddenly realized that he doesn't know how this policy works and what sort of returns he can expect from it. Now the good news is, Gajendra, he has a term plan of 1 crore rupees from HDFC. So we'll set aside his needs of insurance right now. Just looking at this policy, what would you recommend he does?
So this is an endowment policy, and this is not a good thing to do. Because in this policy, the maximum you can expect over a longer time frame is around 6 to 7%, and you are also not adequately insured. So what I would recommend is to come out of this policy as soon as possible. You may forfeit a large amount of money in the initial years, but it's still better to cut your losses right now than waiting for 10, 20, 25 years, after which only you will be getting around 4, 5, 6% return. So my suggestion is cut your losses, come out and invest into a better, into a mutual fund or any other product wherein you feel comfortable.
All right, Gajendra, thank you so much for spending time with us this week and answering our questions. Remember, if you have a question about anything to do with your money, write to us. Email ID is on your screen. And like I told you in the beginning of the show, we're nearing a massive landmark. The show's turning 5 years old. We want to hear from you if you've benefited from the advice you've heard on the show. Send us a video that you can record on your phone to the email ID that's at the bottom of your screen. You can also post it on our Facebook page if you like, and you can get in touch with me on Twitter. We'll air your videos on the show if you get in touch with us on time. Thanks so much for watching. Tune in next week to catch the show.